a story about a little guy that lives in a blue world, and all day and all night and everything.
Today we are talking about Smurf. In an alternate reality exists the planet in galaxy 666, and in this planet there are 200 people, 100 borrowers and 100 lenders. These borrowers and lenders stand divided. They want to do business with each other but can't because of problems like moral hazard, information asymmetry, and uncertainty in the markets as to when they will require liquidity. So the lenders end up not lending to the borrowers. But because of this, the world is working at a suboptimal level of efficiency, and it's going down in flames.
Oh no, what will we do now?
Is that a lender?
Is that a borrow?
No, it's both. It's superbanks. Superbank is an alien from the planet Smipton and has come to save the Earth. Superman does this by creating liquid assets such as deposits that the borrower can withdraw anytime lenders can withdraw anytime they want, and creating illiquid loans that the borrowers have to pay back at a specified date. To go into detail about this, let's move forward. Let's assume that the Smurf only has 3 time periods, T0, T1 and T2. Without superbanks, if someone had given out a loan in T1 after an early withdrawal, they could have only gotten 1. But in T2, if they hadn't withdrawn early, they could have gotten 2. But with superbanks, an early withdrawal gets you 1.28, and withdrawing at the date specified gets you 1.81. And this smoothing of consumption over the time periods actually leads to a higher utility for both the borrowers and the lenders. Let's assume that at T2, the lenders and borrowers don't know whether they're going to withdraw at T1 or T2. And there is a 1/4 chance of them withdrawing at T1. So out of the 100 lenders, 25 will withdraw at T1. And let's assume the lenders are risk averse, and thus they have a concave utility function. Now without superbanks, their expected utility would have been 0.375. But with superbanks and smoothing of consumption, their expected utility is 0.390, which is clearly greater. Thus, with the aid of superbanks, the society is now able to function at a high level of efficiency. But all is not well. Evil still lurks within.
So the evil Smiptonite has come to entice fear among the heart of the lenders. Now they are forced to borrow in the period 1. So the problem is posed as, now in the first period only 100 people have invested, out of which 25 were withdrawing in 25 were withdrawing earlier, but now because of the fear of Smiptonite, 75 people have decided to withdraw in period 1, which leads the bank to lend out 96 rupees, and there remains only 4 rupees to lend out, which turns to 8 in period 2. And this 8 to be divided among 25 people comes out to be 0.32, which is much less than 1.28, which they were being given in period 1. So the withdrawers are forced to withdraw like they would want to withdraw in period 1. But there is a problem. The bank only has rupees 100, whereas it has to lend out 128. So this leads to the fall of superbanks, which is also known as the Great Fall in the history of the economy. So what's the solution to this? These are the 2 matrices and these are the payoffs. In period 1, if both of them don't decide to not withdraw, we turn to period 2. In period 2, we see that withdrawing strategy strictly dominates not withdrawing for both of the players. So clearly we come to a unique Nash equilibrium, which is 1.81 and 1.81, which we can easily substitute into period 1. Now in this, if we find the equilibrium, we get 2 multiple Nash equilibria. Now this is not the solution. The bank, out of the 2 multiple Nash equilibria, the withdraw strategy is where the bank falls into the bank run, which leads the economy to a great fall.
But Superbank, being Superbank, decides to come to the aid of the economy. He thinks of a solution. He thinks that if he can suspend the convertibility of the deposits that the lender made into cash, he can save the bank from going into bankruptcy. But this is not all. Since the lenders here own the bank, they can still try to somehow get their money back. So Superman, with the aid of people like the Reserve Bank man and banker woman draws up another solution. They bind together to form an institution called the government. And the government, with its power of taxation, actually forms an insurance. This ensures the lenders that even if the bank fails, the government will pay out your money, which calms the lenders from the fear of Smiptonites and saves the earth. We have a lot more to say about this in our presentation.